Everyone, welcome to Banking and Finance with Chitrak. Today, we are going to begin our course on KYC and AML certification exam conducted by IIBF. We are going to discuss on money laundering and terrorist financing, the first chapter of the KYC and AML syllabus. This chapter lays the groundwork for what money laundering is, its origin, and why it's a critical global concern. We will also discuss on its impact on the financial system, banks and bankers. We will discuss about some internal agencies and give examples of money laundering, and will also introduce the closely related issue of terrorist financing. Start with the fundamental question: what is money laundering? Simply put, it's the process of disguising the origins of illegally obtained money, or often called dirty money, like from drug trafficking, smuggling, extortion, gambling, bootlegging, etc., to make it appear legitimate or clean or legal money. Think of it as a way to wash away the criminal fingerprints from ill-gotten gains. Now, where does this money come from? Well, this practice is not a new phenomenon. In fact, it has roots in ancient times, with early forms often involving false trade transactions used to conceal illegal goods. A more widely recognized historical example comes from the 20th century in America, where gangsters involved in the illegal alcohol trade needed ways to hide their massive cash profits, right? So, one notorious Chicago gangster famously used the cash intensive laundry business as a front to make his illegal earnings appear legitimate. This is likely where the term money laundering gained prominence. The issue gained even more significant attention with the rise of drug trafficking, as high level dealers sought sophisticated methods to conceal their vast illegal wealth. Now, the term money laundering was first used by a British newspaper called The Guardian in 1972 for the Watergate scandal in US, which resulted in the exit of the then President Richard Nixon. So, legally, it was used in 1982 in the US courts. Again, laundering, metaphorically, you can say that it refers to washing the dirty money to make it clean. Money laundering is not just a localized problem. It has a profound global impact both economically, socially, and politically. The sheer scale of laundered funds can destabilize economies, fuel corruption, and undermine the integrity of financial systems worldwide. It's a cause of serious concern for international bodies and governments. It can affect in economic way, social way, political way. How? Like, it harms the economy by giving unfair advantages to dishonest businessmen. It impacts exchange rates and make it harder to control money supply. It also helps corrupt officials to hide their illegal money and helps organized crime groups to operate. It also influences the country's political systems, which undermines democracy. Now, the extent of this money laundering is very huge. John Walker in 1995 first estimated it to be 2.8 trillion. Now, the UN estimates that money laundering is around 2 to 5% of global GDP. So, if money laundering was a country, it would probably be the fifth largest in the world. We'll discuss on its impact on banks and financial system. So, the banking and financial systems are particularly vulnerable to the effects of money laundering. Criminals often exploit these institutions to move and conceal their illicit funds. This can have severe consequences for the banks themselves. We'll delve deeper into specific risks later, but it's crucial to understand that money laundering can lead to significant regulatory penalties, including hefty fines and even imprisonment for employees in some jurisdictions like US and UK. And India also, if it's found that an employee is related to some corruption or financial problems, then he can also be jailed for that reason. Now, beyond regulatory risks, banks faces serious reputational damage, uh, and scandals involving money laundering can erode customer trust and even lead to the permanent downfall of institution, as seen in many historical cases, which we'll discuss later on. Further, being placed on global blacklists by bodies like FATF can severely restrict a bank's international operations. Operationally, money laundering can lead to direct financial losses through fraud, fake accounts, and unauthorized overdrafts. So, invest in sophisticated AI monitoring systems, and extensive staff training is required to combat this money laundering threat. To combat this global issue, several international agencies played a crucial role in setting standard, coordinate efforts, and monitor countries' anti-money laundering measures. Different agencies gave different definitions, like from the like United Nations against illicit traffic in narcotics and psychotropic substances, United Nations on drugs and crimes, IMF, FATF, Interpol, then the Office of the Comptroller of Currency, Washington, US Senate Subcommittee, Article 1 of the EC Directive of March 1992, the Crown Prosecution Service of UK. All of this has given a different or kind of same definition of money laundering. So the definitions of different international agencies, if you need them, if you need the resources, please comment down below and I will provide it to you, right? To illustrate the example of money laundering, let's look at some real world example. There was a bank called the Bank of Credit and Commerce International, which was founded in 1970. Now, BCCI operated in 70 countries, more than 70 countries, as one of the largest private banks. But its clients included drug traffickers, terrorists, dictators, and arms dealers. So, how the money was laundered? Like they use complex corporate structure. They use layers of shell companies, offshore entities, and holding companies to evade the regulators, exploited weak jurisdictions, and operated from places like Cayman Island, Luxembourg, where the banking laws are not so strict. They also bribed and paid off officials and political influencers of different countries to avoid scrutiny. But what was the consequences? In 1991, the regulators seized 12 plus billion dollars assets after uncovering the fraud it was related to. So the bankers can get lessons like you should know who you're doing business with, you should scrutinize the major shareholders of a bank, and you should invest in those banks which avoid offshore havens, right? Now, there was another bank called European Union Bank of Antigua. It was called the first online money laundering bank. In 1994, it registered as an offshore bank in Antigua, and in 1995, it marketed as the first internet bank. In 1995, it was the first internet bank and allowed anonymous online accounts. So, but what it did was it advertised to criminals and promised tax evasion and dirty money protection, and it gave numbered and coded accounts so they could hide their pass identities using password instead of signature. So you don't need any signature, but you can use password for your transactions, right? But in 1997, the bank collapsed and the officials disappeared with depositors' money. So it's a lesson that if something is too good to be true and it lacks physical presence, it has a higher risk. And for digital banking, the KYC rules should be strict. Next, there was a bank called Riggs Bank of USA, which used to serve the dictators. It, it has two cases. One, it served the dictator of Chilean Augusto Pinochet and of Equatorial Guinea, who was called Teodoro Obiang. In the case one, the Riggs Bank hid millions stolen from Chileans in secret accounts. But in 2005, after it was found that they were involved in the stolen amount, Riggs Bank paid 9 million in fines to the Pinochet's victims. Also, similarly, Riggs allowed 35 million in embassy funds to be siphoned to the dictator's family. Similarly, in 2005, it was fined 16 million for violating the Bank Secrecy Act. So, two lessons we get is that banks must report suspicious political figure transactions. So, let's suppose you are in a branch and some political figure transacts a large amount of money regularly. So, you should be aware and report it to your higher authority so that you can avoid the blame for that. Again, embassy accounts are high risk and one should monitor the large withdrawals from it. You must have heard that RBI issue penalties for different banks regularly, right? So it happens because RBI is the regulatory body of our banks. So when a financial institution or bank fail to comply with some regulatory obligations, they are fined by the RBI. Similarly, we will discuss about some penalties for KYC failures which happened here. In 2013, what happens? A number of fraud checks were encashed. How? Fraudsters opened fake accounts in 5 banks under statutory organization's name. They encashed the checks or DDs and it was undetected for 2 years. Now when RBI found that, it fined 2 of the banks rupees 50 lakhs and 25 lakhs and cautioned the 3 others. Similarly, in 2014, a case of fake fixed deposits and overdrafts took place. Why? Scammers opened FDs in fake names in 11 public sector banks. They took unauthorized overdrafts against these FDs, and obviously they didn't pay it back. Now, the RBI fined 3 banks 1.5 crore each and cautioned 8 others. Why? Because the key takeaway is that the fake accounts took place because there was no proper KYC checks, right? So, fake accounts are actually a gateway for money laundering. After that, what happened? RBI was very strict with the KYC norms, and a non-compliance of KYC will lead to heavy fines, which ultimately also damage the reputation of the bank. Brings us to trade-based money laundering, or TBML. What is this? This involves using trade transactions to disguise the proceeds of crime, and some common warning signs for TBML are undervoicing, where the stated value of goods doesn't match reality, ghost shipments where no actual goods are exchanged, and the use of shell companies with no real businesses. So, what are these? Undervoicing, underinvoicing, ghost shipments, and what was the other one? Shell companies. Right? Now, we'll discuss two examples. The case one is a fake imports by public sector bank. It was a 6,000 crore scam in 2015. What happened? 8,000 fake remittances worth around 6,000 crore was sent abroad for imports, and the imports actually never took place. The shell companies were used to route the money, and 6.5% cash was deposited to avoid detection. Now, after finding out this, the ED and CBI arrested 10 people and including 3 bank officials. Another case was fake accounts and remittances were made. It was a 500 crore bank. So how it worked? One person operated 70 fake accounts, 70 across 7 banks. It used to send money abroad as import payments but diverted funds. So its lesson is that the multiple accounts under one name is a big red flag. Like as I said, the warning signs are over or undervoicing, or that is fake trade values, ghost shipments or no real good exchanged, and shell companies or no real business activities. Can be the lesson for banks and bankers after listening to all these examples is that there are many regulatory risks if you do not comply for the rules. So you can have heavy penalties, and it can lead to millions and dollars of crores. The employees can also be jailed, and remember that the employees can also be fined. There is also reputational risks. The customer lose trust when scandals like BCCI, scandals like what happened to BCCI, if it happens, then the customer obviously loses the trust, and you also get the risk of getting globally blacklisting. There's also operational risks like fraud losses. What happens if fake accounts, ODs, and laundering? It leads to financial damage of a bank, and also the compliance increases, and it ultimately also increases the cost. So the key takeaways is that KYC is the first line of defense. Always when you open an account, verify the identities minutely, and after opening the accounts, monitor its transactions. Second is trade-based laundering is rising. So when you are giving money or advancing to a company or a business, always watch for fake invoices and fake imports. Also, the banks must report suspicious activities, and if you fail to do so, you can be both fined and jailed. Let's briefly touch upon terrorism financing. So, while related to money laundering, it has a distinct objective. Terrorism financing, it is the process of providing, collecting, or moving funds to support terrorist acts or organization. The sources of funds can be both legal and illegal. Legal funds include donations and legitimate businesses and charities, and illegal funds obviously involves things like drug trafficking, kidnapping, and fraud. So it's important to again understand the differences between terrorism financing and money laundering. So the source of funds, the difference in source of funds is that in money laundering, the source is always illegal. It's always drugs or corruption. But in terrorist financing, it can be both legal and illegal. The purpose of money laundering is to hide illicit origin to use the funds legally. But in terrorist financing, the fund is violent acts. The fund terrorism, even if the source is clean. The last difference is concealment focus. money laundering is disguise where money came from. So it disguises the source of money. But in terrorism financing, it disguises where the money is going. This is very important, right? So similarly, the UN International Convention gave some definitions like illegally providing and collecting funds knowing they will be used for terrorism is the offense. The scope is the funds need not be actually used for terrorism. The intent to use it for terrorism is enough, and it covers any act causing death or serious harm to civilians to intimidate governments or populations. So these are all the three things, three definitions, but three reasons for terrorism financing. So a good example is that a charity collects donations for orphans, but secretly it sends money to banned militant groups. This is also terrorism financing. The challenges in defining terrorism is there is no global consensus. Like one country's freedom fighter is another's terrorist. Example Hamas, Khalistani groups, etc. Religious and national bias. Some nations tolerate groups, others ban. Right. So also we'll discuss about some link between money laundering and terrorism financing. In both the methods, shell companies are used. That is, the fake businesses move both terrorist funds and laundered money. Hawala network is used. What is that? It's an informal banking system, bypassing regulated channels. Also, trade-based fraud is used, like I said previously, over invoicing or under invoicing to disguise the fund movements. The critical differences we have already discussed. Money laundering is dirty money to clean money, and terrorist financing is clean or dirty money to violent purpose. Now, why banks struggle to detect the terrorism financing money? It's especially because the amounts are very small. Terrorist attacks do not need a large amount of funding. It can happen in less funding, and so it's very hard to detect the amounts. Also, terrorism financing uses legitimate fronts, so you cannot say that it's an illegal fund. It's coming from the genuine business, but the intent to use it is different. So, how can the banks take action? Firstly, KYC is must. One should scrutinize any charities, NGOs, and politically exposed person minutely. You should be very aware of the transactions of the customers of your bank, and you should always flag the transactions which are not right if you think, and if some money is being sent to some conflicted zone, you should flag it. Finally, the staff should be adeptly trained to recognize any problems related to the transactions, and also one should recognize the ideological question of a staff. So terrorist financing isn't only about the amount, it's about the intent. A single unchecked transaction can fuel a catastrophic attack. So this concludes our first chapter on the fundamentals of money laundering and introduction of terrorism financing. Thanks for watching. Please subscribe and like, because the next parts are coming soon. And if you need anything, mail me and comment below if you need any help. Thank you.